When retail traders first discover options, they usually treat them like highly leveraged lottery tickets, directional bets on whether a stock will go up or down. Professional market makers do not guess direction. Instead, they view options as modular, geometric building blocks used to sculpt exact mathematical boundaries of risk and reward. This is a parity graph. It visually plots a derivative's exact intrinsic value at expiration across every possible underlying price. This complex shape is algebraically synthesized by isolating the linear slopes of individual options and adding them together piece by piece. To survive in derivative markets, a trader must calculate exact risk thresholds and break-even boundaries across all possible future price states, rather than relying on directional intuition. Synthesizing piecewise geometry from an options chain is the deterministic mechanism professionals use to quantify their structural edge and eliminate subjective guesswork. This graph shows the slope of a standard long position in an underlying asset, like 100 shares of stock. It maintains a constant, unbending one-to-one relationship with the asset's price, giving it a permanent slope of +1. Selling the asset creates the inverse, a descending line with a constant slope of -1. This is a parity graph for a long call option. Notice the asymmetry. Unlike the straight line of the underlying stock, an option introduces a rigid bend, a vertex, exactly at the contract strike price. Below the strike price, the call's intrinsic value is floored at 0. Above the strike, the option goes into the money, gaining point for point in parity with the underlying asset. A long put creates the geometric inverse. Its intrinsic value remains flat at 0 for any price above the strike, but rises point for point as the asset's price falls below the strike, giving the position a slope of -1. When you short these options, you take on the exact opposite geometric obligation. Selling an option inverts those positive slopes into negative risk slopes. Selling a call creates a flat 0 slope below the strike and a slope of -1 above it. The seller is exposed to theoretically unlimited directional risk as the asset's price climbs. By assigning strict numerical constants of +1, 0, and -1 to these line segments, we convert abstract financial contracts into modular mathematical integers, ready for algebraic calculation. We can apply the concept of superposition to these integers, combining multiple derivative contracts on the exact same underlying asset to sculpt an entirely new risk profile. Consider the specific setup for a synthetic long position. We buy a call option while simultaneously selling a put option at the exact same strike price and expiration date. When we execute the algebraic addition of the two slopes across the entire price continuum, the vertex at the strike price disappears. The math is perfectly rigid. Combining a slope of +1 above the strike with a slope of +1 below the strike creates a continuous slope of +1 across all possible price points. This continuous line exactly replicates the parity risk profile of owning the physical underlying asset itself. Manipulating these geometric blocks in reverse, selling the call and buying the put, synthesizes a short position. Traders use this to bypass institutional restrictions on short-selling physical assets. Through linear superposition, the piecewise geometry of options can perfectly synthesize the asset itself, establishing rigid arbitrage boundaries across financial markets. We can scale this algebraic model to evaluate complex multi-leg derivative portfolios across a wide range of strike prices, such as 95, 100, and 105. This matrix maps a butterfly spread, a multi-leg option strategy combining bull and bear spreads to limit risk and define profit boundaries. Here, we buy 195 call, sell 2 100 calls, and buy 1 105 call. We perform the piecewise calculus starting with the outer boundaries. Below 95, all options are out of the money, so the total slope is 0. Above 105, the active slopes of +1, -2, and +1 mathematically cancel out, returning the sum to 0. Now for the inner intervals. Between 95 and 100, only the first call is active, creating a slope of +1. Between 100 and 105, the two short calls activate. Their combined slope of -2 is added to the previous +1, resulting in a net slope of -1. Notice the difference between the parity graph we just built and an expiration profit and loss graph. Parity maps pure intrinsic value, but true P&L must account for the initial capital paid or collected to open the position. To reveal the actual risk and reward zones, we apply the net debit, the total upfront cost of the options premium, to the geometric model. The entire structure shifts vertically downward along the y-axis. The exact break-even point is determined algebraically. Take the strike price and add the quotient of the profit at that strike divided by the slope of that specific interval. Visually, these exact break-even coordinates sit right where the shifted positive and negative slopes intersect the x-axis. The vertical placement of the graph dictates profitability based on market pricing, but the rigid geometry of the slopes dictates the absolute, unchangeable boundaries of your structural risk. The parity graph perfectly maps the geometry of risk if expiration occurs at a specific price. However, it incorrectly assumes that all price outcomes across the x-axis are equally likely to happen. This chart shows a Gaussian probability distribution layered over our butterfly P&L graph. In empirical financial markets, extreme deviations far from the current spot price are statistically much less likely than small localized movements. We extract the expected value by calculating the specific area under this probability curve that intersects with the profitable geometric zones of our position. But expected value alone is not enough. The final step is discounting this probabilistic value by the cost of capital or interest rates over the option's lifespan. That calculation yields the true theoretical value of the position. We then contrast this rigorously derived theoretical value with the actual premium being charged by the market on the options chain. This defines your edge. Edge is the exact mathematical delta between your calculated probability-weighted theoretical value and the current market price. Without the foundational geometry of the parity graph mapping the boundaries of profit and loss, it is impossible to know where to apply the probability curve in the first place. Professional quantitative traders do not predict the future. They map the deterministic geometry of expiration, apply a probability distribution to those defined boundaries, and deploy capital strictly when the calculus dictates a positive expected value.